What's up, everyone? Welcome to another Market Radar podcast. It's good to be back. Sorry for the absence over the last 2 weeks, but Gamma was able to take care of the podcasts. Hope you guys learned a lot from those. Let's take a look at what the NASDAQ did this week. Absolute tear after the dip that we've had 2 weeks ago. And it was actually quite a quick move up to upper vamp. So much so that you can notice the lower vamp has been flatlining just because of the increase in volatility. That's essentially telling us like the possible short-term price action is able to fluctuate between upper vamp and lower vamp there due to the level of volatility that we're seeing lately. And at the end of the day, though, it's bullish trend. We're still above Momo. We do not short bullish trends, regardless of how bearish you might be. It's just not a good idea. Bullish trends tend to lead to higher prices, especially with the stage 3 theory that we have been speaking about. There's definitely a probability of equities moving higher. There's nothing that would completely reverse them at the moment. So we'll talk about that a little bit later, more in depth, but let's go over to bonds. We did see bonds reverse today on Friday. However, it is remaining above mid-vamp, which is it's important. But at the end of the day, this is bearish trend. We do not buy bearish trends. We're not seeing the signs of deflation just yet. The bond trade is not here, especially with the stage 3 of our theory. The long end of the yield curve will rise further. So definitely not the time to buy bonds. And we're just going to hold on and wait for Momo to keep coming lower when the time comes. That'll just give us an even better entry. And so it's all about patience. This week, bonds did all right. It is positive on the week, but mostly flat. We'll see how it develops. So, question I have for you, Gamma. Commodities. We saw commodities rise quite a bit this past week. Actually, DBC went bullish trend, and bullish trends lead to higher prices. So, what does this mean for inflation? And just in the whole grand scheme of stage 3 and stage 4, what does this mean with commodities being higher, and especially crude oil? Crude oil is much higher than this commodity index here. But 5-year break-evens are doing the exact opposite. They're actually going lower. So what is this telling us? The break-evens are telling us inflation is not an issue, but then commodities are showing inflationary signs.
Right. So before we dive into commodities, let's talk about why specifically bonds moved lower this week, equity, or in the last week or so, equities moving higher, bonds moving somewhat lower, and obviously commodities bidding up along with crude oil. So this week we had jolts coming in and missing estimates by nearly 640 million job openings. And the available or the listed job openings in the market are the lowest since March of 2021. So what does that mean, right? It basically means that labor market imbalance that Powell and everyone was talking about the last year and a half or so is coming back into basically equilibrium. And that's something that that's going to basically wail out in the market, right? Because the Fed was very vocal about this situation where the labor market had this imbalance where they just wanted to see it come back down. They didn't want to destroy it per se, but they wanted to equalize it because the job market was just so hot. And Powell basically was putting this out there that they would continue to hike until they got inflation under control. And they were alluding to the fact that the jobs market needed to basically loosen up to bring that inflation, the overall inflation under control. And that's what we saw this week with jolts missing to the downside. And then GDP came in with a preliminary report at 2.1% for the quarter over quarter number. That's still positive enough to not really be a concern. So back to what you said earlier, Artie, about the NASDAQ. There's really no growth concern there to push this market lower, at least not yet, in terms of economic data that's being reported, obviously. And then we had the PCE come in expectations. So again, inflation is not really beating the market's expectations to the upside, as you said earlier, with making it a very interesting point with commodities doing what they're doing. And we're going to get to that in a second. But on Friday, when we're recording this podcast today, the non-farm payrolls again came in above estimates. Okay, they basically signaled that the labor market is still more resilient than people are expecting it to be, and the unemployment rate only ticked up 30 basis points. Now, everything I just told you, it all wraps back into why commodities are moving up, but inflation isn't yet. And and we can see this, as you said, by the break evens. They're moving down, right? So break evens are going lower. That means the anticipated inflation rate by the market's actually going down, but commodity prices are going up. And what's going on here is stage 3 of the compound landing. And we spoke about this in the last few podcasts, but to summarize it all, stage 3 is the part of the cycle where the market has to basically, you hit a juncture where everyone's been calling for a recession because of all this Fed policy, but little do they know everything is lagged and everything's pretty much backed up. But nonetheless, everyone's calling for a recession. And we're at the junction where the recession doesn't happen. But the market is going to have to basically pick a side. Are we going into a recession? Or are we not going into a recession? So what happens if there is no recession and the market was basically always pushed in the path of a recession is coming, a recession is coming, a recession is coming, but there is no recession? Well, then everything that would go up in a recession, or everything that would go up if there was no recession would start to rise, even though inflation per se isn't going up that much, right? Directly. For example, commodities. If growth is not going to slow down to the point where we are going to have a recession, right? That means there's going to be demand for the commodities and other materials that the market basically pushed lower in price, thinking there would be a recession. Yet there isn't. And this is going to boost this is going to allow these commodities, so oil, for example, to move higher. Even though it's not directly correlated to inflation, it will over time lead to further inflationary pressures. Now, there's something to say about how inflation works with stage 3, right? You have to look at commodities as a whole. Oil had no disinflation. It was completely deflationary on a year-over-year basis, right? If we take a look at oil and we look at where it was from, year over year, it wasn't slowing. It wasn't like it was only going up, 1%, 2%. Oil literally went down 45%. Right? So oil fell. This was deflationary pressure within the disinflationary theme of inflation coming down. So again, if you have this deflationary pressure, but you don't have this deflationary market environment, the market has to hit this juncture where it's going to say, okay, no recession, so growth pressures are going to persist. So we have to basically remove the discounts we put into the market or into all these assets over the last year. And that's what we've been seeing the last couple of weeks here with oil prices going up. More so oil the last couple of months, but the trend really wasn't defined up until the last couple of weeks. And to be quite frank with you, to those that are listening, commodities now, DBC's bearish trend, they can go higher. Send it. This can go up.
Bullish
this
trend.
Can go up.
You mean, right?
Bullish trend.
Yeah.
Oh, what did I say? Bullish trend?
You said bearish.
Excuse me. Bullish trend. Yes. We don't trade against trends here. Bullish trend commodities, bullish trend gold. This can go up.
So this move, what you're saying is this move is so far just coming back from the large discount. Yeah, it's rebalancing now that the outlook is starting to shift from a recession to a soft landing or no landing. It's just rebalancing to account for that now.
Right, and that doesn't necessarily mean that the overall market is going to boom. And this is what I want to go back to what I've been saying the past couple of weeks on Twitter. Just because the NASDAQ is up and can continue, we said this, there shouldn't be a reason why NASDAQ crashes from here. It can continue to bid higher, right? For whatever reason. It doesn't mean that it's going to be the right trade or even per se a profitable trade in the fact that you may have to buy. And remember, we're talking about using leverage here, not just blindly longing the triple Qs or whatnot. So you can get caught in chop. And a good example would be this. If you were long NASDAQ from June 15th or whatever, the June 16th, if you long the highs on June 16th, you would barely be up on QQQ, but you would be down in volatility drift on the T triple Qs, right? And that's because it comes back to the environment being favorable, aka probable, a probable environment for higher prices. If the environment isn't probable for higher prices, then the edge that you have isn't really there. And what you're doing simply is just more gambling than what you would do if you had some sort of edge, right? It's all gambling at the end of the day. But if you just blindly say, okay, follow the trend, which you could do, and it worked great here. But the reason why you have to pair this with the system is because you need that double confirmation, especially if you're using leverage. If you decide to go in with leverage, mistakes can be lethal, and they don't just hurt. They don't just sting. They're gashes. Okay, you can take deep drawdowns with mismanaging leverage. So that's why Aries is a double or I should say a double variable system where it has to have both variables aligned for the executions to take place. Like it or not, you may miss certain moves here, you may miss certain moves there, you may also be out of certain moves when they go against you, which is favorable, right? But over the long run, you want to isolate those high probable environments, compound them aggressively, and go on to the next. And that's how this works, right? So in terms of stage three is the environment that gets everyone. Realistically, stage three would be optimal if equities pushed up new 52-week highs and kept going. That would be ideal stage three.
That would be that would be really capturing as many people as possible,
right,
before entering stage four.
Now the problem with that is, and I'll explain this to you. A lot of people listening to this will say, okay, stage three, I can just long the NASDAQ. I'll ride out the wave until stage four hits, right? The problem with stage four, it's a crack. Boom, just happens. We can get an idea that it's coming, but boom, out of nowhere, though, who could have seen it coming? Shit hits the fan. No one knew what happened. If it's a bank going down, if it's, corporations laying off massive amounts of people, big corporations you could have never thought filing for bankruptcy, it could be anything, right? Just boom, out of nowhere. And you won't exactly know what will get you into stage four, but you can tell it's almost coming, right? So we're just getting into stage three now. So there's some room here. The problem is stage three, like I said, stage four will just hit. And in the process, you will not be able to determine which dips are buyable and which dips are not. Meaning, for example, let's just say NQ goes up, right? And then you have a massive move down, and we'll go back in time. Just something to give you some reference like this, right? You get a move like this in stage three. You don't know if this is the end. There's not enough confidence there to give you the idea, to give you basically the fortitude to go in and say, this is going to hold. You don't know. And what ends up happening is you'll end up getting a Momo. You'll be like, okay, maybe it'll bounce here. You get under Momo, and then something like this happens. This is a better example. This could happen in stage three where you move down like this. You think, oh, the dip's here, and then just it shits the bed. And that's why you have to have the system on your side. It's very important. That's why when you use leverage, you don't want to be taking 50, 60, 70% drawdowns. Too lethal. That's almost too lethal to come back from. Yeah. You do not want to do that.
And so what's a realistic thing that you think could happen that would take us from stage 3 to stage 4, which stage 4, that's the deflationary recession, bonds going up, that whole scenario. What's something that you can realistically see causing that? For me, what I think, my opinion, is other countries are not handling the current situation as well as America is. For example, Europe, Canada, they're already showing cracks. I think these countries will crack first and take down the American market with them. Is that something that you think is possible?
Yeah, I do, and I also think that there's a lot of pending. Again, remember the whole idea of stage 3 in itself, putting other countries on the side, is that there's pending policy actions that are still wound up in lag, in term of lag, and they have not melted through this economy yet, right? So there's still a bunch of policy basically backed up in the system. So you have what you're talking about unfolding, right? Look at Europe, look at China, right? You can look at all these things. And at the same time, you have these lags that are also coming out at the same time, right? In terms of like hitting the market. But we're not in a recession just yet because the lags are so backed up. And this stuff happening, across the world outside the United States is not bad enough just yet. The market can kind of shake it off for now. But remember the stage three, that stage three is the normalization process. It's the idea that the Fed is high. Think about it like this. You're a market participant, right? We got to dumb this down, right? For those that maybe don't understand the complexity here. So you're a market participant. The Federal Reserve just hiked interest rates the fastest they've ever done, or the fastest they've done in modern history, right? In terms of percentage change, fastest. And inflation has gone from 9 to 3%. Growth is coming in at 2.1%. There's no recession. What are you worried about, right? It's this idea that, man, maybe the market can handle higher interest rates. Maybe the economy is way more robust than anyone would have thought. And maybe I'm the idiot for sitting here chanting a recession. That is precisely stage three. And that action is that is how everybody gets caught, because they look at the situation and they say, well, you know what? I might be wrong too, man. Maybe recession, people are getting laid off, unemployment's not ticking up, there's enough job openings. Maybe the labor market's really just so robust. And maybe the Fed has gotten interest rates to a point that is not so restrictive as everyone thought they would be. Going from 0 to 5%. Everyone's like, oh, 5%. This is the same rate, same level that the Fed was at before 2008. They're going to 2008 is going to happen again, right? This whole idea of economic implosion, but that's not happening. So maybe it was all bullshit. And it's the realization where everyone goes, maybe it's all just bullshit. There's no recession here. Bid equities up, send it, right? That gets everyone entrapped. And then when it comes, everyone would have been like, oh man, I couldn't see it coming because it didn't make sense. But it does if you understand the way people think, right? People, if they cannot see an issue in front of them materialize quickly, they start to lose faith at an exponential rate, right? If you see something in front of you and you cannot believe it happens, or you don't believe it's going to happen, but you want to see if it does, as time goes on, you will start to just lose faith at a faster and faster rate, and then you'll just give up on the thing altogether, right? And that's exactly what stage three is. It's this idea that everyone's going to give up on the recession.
It's kind of a prime example of that. We just saw it after COVID, when Federal Reserve comes in, prints 40% of the money supply, everything is just skyrocketing. And there were so many people that were like, this can't be happening. Like, how is this happening? The whole world got shut down. Why are equities making new highs? And people just did not understand it. And so
Right.
this kind of would be the other side of that coin, where, well, it would kind of be the same side of the coin.
It's the
honestly.
same.
It's the same side of the coin.
Yeah.
And eventually they capitulate, and that's when it happens.
Right. And the core behind stage three is the idea that, okay, if the market's going to normalize at a higher level of interest, right? So let's take the twos and tens, for example, right? This is the difference between the twos and the tens. And this spread is inverted, meaning the rate on a 2-year is higher than that of a 10-year, implying that rates have to come down, right? Rates on the front end are going to come down. Otherwise, the 10-year would not be below the 2-year, right? That's makes sense. A lot of people understand this concept, right? Simple yield curve inversion. Well, if you're not going to have a recession and the market's going to start thinking about this soft landing and really price it in, I'm talking about really pick up on it, there shouldn't be such a dramatic discount on the treasury curve, because you should not have a situation where the Federal Reserve is nearly 100 basis points, excuse me, the 2-year is nearly 100 basis points over the 10-year if there's no recession risk, imminent recession risk. Meaning, the reason there wouldn't be a recession risk right now is the Federal Reserve has found a new normal. Well, the Federal Reserve has found a new normal, call it a 5%, 4.5%, 5%. The 10-year should trade much higher, right? And that's the problem. The problem is, as that 10-year or as the long end starts to try and normalize and price out that recession discount, and that's typically done through what's called a bear steepener, right? Where the yield curve the yield curve tries to revert, but not because the Fed is bringing down interest rates on the front end, which is above that of the long end, but the long end is actually going up above the front end. So it's kind of like a seesaw, where the typical way this happens is this reverts because the Fed is cutting interest rates. They're dropping the value of the 2-year because they control short-term rates. And the 10-year remains more constant while still trending lower, but the 2-year drops faster and it reverts this. And that's typically what's called a bull steepener. That's when the Fed is cutting interest rates. That's typically, again, associated with a recession. You usually get these bull steepener moves as recessions happen.
Yeah, because they're cutting rates because they need to stimulate the economy, because we're entering a recession.
Right. Now, why would the Federal Reserve need to cut interest rates dramatically at this point? They wouldn't, because the economy is obviously, quote unquote, resilient, right? It's chugging along just fine. Unemployment's at 3.8%. These aren't like crazy, like scary levels. So what's going to happen here, and this is the concept, and we have been seeing this the last couple of weeks here in the yield curve, and I think this does continue, where the yield curve tries to revert. I don't know if we'll actually get that reversion. If we do, that would be peak stage 3. That would be like, oh my God, like that, we're getting close to stage 4, right? But like stage 4 is around the corner type of thing. But I do think that the yield curve will have to price out some of this recession risk, and it won't be done by the front end coming down, meaning we're going to get a continuation of bear steepeners here. Bear steepener price action, which you can see here is in red on these top red bars. On Friday, we had a 50-50% day, meaning like in the last couple of days, it was bear / bull steepener. But long story short, you can see a lot of this price action on this yield spread move higher has been bear steepener. And I think that's going to continue. And what that really means, simply put, the yield curve, the long end of the curve is going to have some pressure still. Now, this can all change, obviously, if stage 4 presents itself. Remember what I said at the beginning of the podcast. Stage 4 will just crack. And the stage 4 signal will be ZB and bullish trend. That will be the stage 4 signal. ZB has not gone bullish trend since 2021. So if you think like DDAP is so sharp, you did not get finessed anywhere along this point of time. You may have thought that there was some triangle bounce, some Fibonacci circle, or some type of bullshit that you could have timed and reverted bonds from 4% down to 2%, but that did not happen. DDAP has been very consistent in telling us that yields have downside potential. Now, remember this, yields have downside potential is all part of stage 3. Stage 4 will come, the bond trigger will trigger, and when that does, that will be the signal that stage 4 is here and going on forward. Now, what does it mean in terms of inflation now, right? Because everyone's hearing, okay, you're saying bonds can go lower, but inflation's down. Is inflation going to go up? And this is where it gets simplified. So bond yields can go lower because the economy has to take that recession risk out of the curve. It has to remove that discount of a recession. Therefore, the long end has downside risk. Again, that's also illustrated here by just being bearish trend. Bearish trend tends to lead to lower prices, right? So bonds have downside, yields have upside risk. And therefore, if you're pricing in or you're pricing out that recession, commodities are going to get the bid too, right? Because commodities are going to have this basic rebalancing of growth expectations that will continue to put pressure on it to the upside. Now, all in all, as this unfolds, what's going to happen is commodity prices are going to go up, yields are going to go up, and you're going to get this bleed of inflation, right? It's going to be this idea that, oh, inflation's accelerating again. But what you're seeing is just you're seeing the normalization of this stage 3 scenario. Now, it doesn't mean that inflation is going to new all-time highs or new cycle highs, right? It just means that inflation, it was very easy for inflation to go from 9 to 3%. Going from 3 to 2 or 1 or wherever you want to say from here, it's going to be a lot more challenging. And most likely, it's going to be rather choppy. And in the process, I think that's how we're going to play the stage 3 portion of this cycle out. And then obviously, stage 4 will come and crack, and that will be led by the bond signal. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on Twitter @TheMarketRadar.
I want to add one last thing before we go. Go back to the tens and twos. This is a new indicator that we just came out with. It shows you which way the yield curve is moving. So is it reverting or inverting with a bear steepener or a bull flattener? It's a great indicator. It's free. I'll put it in the description of the video. Check it out. It's super helpful.